This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Happy Thanksgiving, folks. I'm John Budden, and welcome to Money Talk. Here's the lineup for today's show. We start with Dave Sally from the Ottawa Business Journal, and then go to Matt Hendricks, who's Senior Vice President at Sprott Asset Management. After the break, we take a look at the new mortgage rules with Rob Lister of RateSpy.com, and then to Dale Jackson, who will talk about passing the cottage to the next generation and the tax implications. After the news, to John Petrides, Managing Director and Portfolio Manager with Point View Wealth Management, and he talks to us about the latest U.S. jobs data. And to conclude today's show, we go to David Prince, who is the founder of Harbinger Capital Markets Research, and then on to George Giro, who is Managing Director at RBC Wealth Management. But first, let's go to Dave Sally at the Ottawa Business Journal. I'm joined by Dave Sally of the Ottawa Business Journal. I hope you're enjoying the weekend and getting ready for Turkey.
Absolutely.
Now, Dave, the leader of one of the capital's most dynamic manufacturing companies was named Ottawa's CEO of this past year. The co-founder of the region's largest microbrewery said his company isn't ruling out a move into recreational cannabis, and an upstate New York airport launched new flights to Florida in a bid to draw more business from Eastern Ontario snowbirds.
That's right, John. Well, let's start with the announcement of the 2016 CEO of the Year. Now, it's a name that might not be familiar to a lot of listeners, but it probably should be. David Ross, the chief executive of Ross Video, has been named this year's top CEO by the Ottawa Business Journal and the Ottawa Chamber of Commerce. Ross Video has been in existence for more than 40 years and now employs about 640 people in Eastern Ontario. The company designs and manufactures equipment for live events and video productions like the Super Bowl. Over the past 2 decades, the firm has had an impressive average growth rate of about 18% a year, and its annual revenues are now approaching $200 million. Mr. Ross himself began dabbling in programming at the age of 9 and started working for the family-owned company while completing his computer engineering degree. He joined Ross Video full-time in 1991 and was named chief executive in 2006. He now joins a list of past CEO of the Year honorees that includes leading Ottawa business figures such as Minto's Roger Greenberg and Bernie Ash of the Ottawa Sports and Entertainment Group, who received the award last year. Under Mr. Ross's watch, Ross Video has acquired several smaller companies and vastly expanded its suite of products into areas such as robotics and virtual reality, helping make the company a worldwide leader in the field of video technology. Mr. Ross also sits on the board of Invest Ottawa, where he helps promote the nation's capital as a business destination.
In other news, this past week, the co-founder of the region's largest craft brewery made a comment about potentially expanding its product line that's sure to get people talking.
Absolutely, John. During an event Wednesday night at Craft Beer Market, Beau's CEO, Steve Beauchesne, was asked by an audience member if he would ever consider getting into the recreational marijuana industry once pot is legalized. Mr. Beauchesne had a very interesting response. He didn't say yes, but he also didn't say no. The brewery's co-founder said that while Beau's is not actively pursuing the idea of getting into the cannabis business, it's not ruling it out either. Mr. Beauchesne said if there's a way to do it that's responsible and fun, then maybe Beau's would consider it. He did acknowledge the company has spoken to officials from Tweed, the marijuana producer based in Smiths Falls that currently sells medicinal pot to licensed patients. Mr. Beauchesne added that while he personally favors freedom of choice when it comes to marijuana, he also had social responsibility concerns about expanding into that market. The company's beer is brewed with organic ingredients, and Beau's itself is a certified B Corp, a designation for firms that meet standards for social and environmental performance, accountability, and transparency.
And finally, a discount airline in the U.S. is attempting to woo travelers from Ottawa to venture across the border for flights to Florida.
That's right, John. Allegiant Air launched its debut flights to Florida from Ogdensburg Airport in upstate New York this past week. The airline is betting that some Eastern Ontario snowbirds will be willing to make the 1-hour drive south of the border to catch a flight to Orlando or Fort Lauderdale with the promise of saving money. Allegiant's fares to the Florida cities start at $56 US one way. The airline is making no secret of its desire to lure travelers from Canada, even listing the airport as Ottawa, Ontario /Ogdensburg, New York on its website. Now, a spokesperson for the Ottawa International Airport Authority said it's hard to predict what impact the new flights will have. Krista Keeley said any potential erosion in the Ottawa Airport's revenue is a concern, but she added Allegiant's low fares could actually stimulate more overall demand for air travel, and that could benefit Ottawa in the long run. For now, Allegiant is offering direct flights to Orlando and Fort Lauderdale twice a week.
And Dave, what's on the OBJ radar for the coming week?
Well, John, it's once again time for the monthly Mayor's Breakfast event at City Hall, which is sponsored by OBJ and the Ottawa Chamber of Commerce. And this Friday's guest speaker is Ontario Premier Kathleen Wynne, who is sure to draw a big crowd. For more information, go to ottawachamber.ca.
Thank you so much for joining us on Money Talk. Great update, and we will talk to you again next week. I hope you enjoy the rest of the Thanksgiving weekend.
Well, you too, John. Happy Thanksgiving.
Thank you. Take care. Now to Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management. Well, it's great to be joined by Matt Hendricks, who is Senior Vice President, National Sales at Sprott Asset Management. How are you, Matt?
Very good, John. Happy Thanksgiving to you and all of our listeners.
Likewise. We had quite a week. Market sort of traveled up and down with a range of about 300 points in the United States. And there was news today. Jobless numbers came in, and they were lower than expected. And we have to keep in mind that the jobs that are being created are mostly part-time jobs. And then also, we had a private gathering here in Ottawa at the Lord Elgin Hotel on Wednesday, and Eric Sprott and John Embry came in to speak with Steve Higgins of the Royal Canadian Mint about the gold market, and they really gave a big picture overview of the situation. But as we've learned, gold can be volatile, and it was smacked down hard this past Monday. And I just wanted you to give us a bit of a summary of the Precious Metals Forum that we held, because I thought it was a very good gathering of institutions, family offices, and some very significant local investment advisors.
Right, John. And the timing couldn't have been better. As you said, the gold got taken to the woodshed once again with the Chinese holiday. So we had Eric Sprott and John Embry in to have a really high-level conversation about precious metals to institutions, family offices, and certain investment advisors. And really the message continues to be the world governments have got more debt than they can ever service. Interest rates are negative. You know, the U.S. engine cannot cover the funded and unfunded liabilities that they have to the tune of 80 to 90 trillion. And an allocation to precious metals is vital in this environment. And again, the question is how high do you go? Anywhere from 5 to 25% actually was discussed in the forum, a mixture of bullion and the equities. But it was a very, very well-received event, and we'll see where we take it from here.
And precious metals, meaning gold and silver, have their place as an alternative to paper money. I think we should try and put this in perspective for investors, because everybody should talk to their registered investment advisor to determine the appropriate allocation to gold, silver, gold shares, silver shares as a hedge against potential inflation and as a currency alternative. This is very important. And could you also comment on the strategies that should be there to complement a holding of gold and precious metals?
Absolutely, John. We always say that we've got many ways to play gold at Sprott. There's the passive way of just owning the physical bullion through our bullion funds and our bullion trusts. And then there's the active part of it where we have the Gold and Precious Minerals Fund, which buys basically a basket of gold stocks, and of course our Silver Equities Class Fund, which buys a basket of silver stocks. And I certainly believe that you should own a mixture of both depending on your risk level. owning the bullion technically is the lower risk play, and owning the shares is leverage off of the bullion. So again, an allocation in terms of a percentage, and then a mixture of bullion versus the equities depending on your risk level.
And then the point that I want you to address is the strategies that are along with your alternative strategies, and by that I mean the core strategies, which are so important for stability for a portfolio.
Well, absolutely, John. At least in the case of Sprott, we've got John Wilson's enhanced strategy, which is core North American equity with downside protection. We've got Dennis Mitchell, who's a world-class global and U.S. dividend manager. Scott Colburn, who is doing really, really well in the fixed income space, a global unconstrained mandate. Eric Nuttall, who's got the number one energy fund in Canada over 1 in 3 years. A sleeve of precious metals, a sleeve of agriculture, timber, and infrastructure, and really that's your rounded portfolio, and that should hold up with markets at tops with the U.S. election coming up where there's a lot of uncertainty. You certainly want to have a diverse portfolio with defense.
Sounds like a good team, the Blue Jays.
Well, the Blue Jays are doing very well so far, John, and I certainly wear my hat every other day.
Before you go, Matt, could you give us your coordinates for listeners and advisors?
Of course, John. I'm always available toll-free at 1-866-299-9906. And always please remember to visit Sprott.com. We have a lot of great information on our website.
Thank you so much, and have a wonderful Thanksgiving, and we'll talk again same time next week.
Absolutely, John. You too, and again, happy Thanksgiving to our listeners.
Okay, folks, after the break, Rob McClister of RatesPy.com. Stay with us. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
The TSX Financial Services Group was basically treading water over the course of the week. Well, you certainly wouldn't know it by looking at the intradays for these 5 sessions. Today, down by about 1/5%. One stock that was quite the yo-yo trade as well was Genworth MI. Genworth came out crunching the numbers on Ottawa's decision to tighten lending restrictions for mortgagees. And as you can see, the reaction was quite stiff, down 12.7% over the course of this week. The company said about half of its business is a new homeowner. And about 1 out of 3 of those customers are going to have trouble being able to get a mortgage at that 4.6% rate, even though mortgage rates are half that and even less. So the industry is bracing for tighter rules out of Ottawa. We've already heard that some plan to curtail their mortgage products as a result. Our next guest says this may mean getting out of certain businesses altogether in the non-bank lenders. For more, RatesBuy.com founder Rob McClister joins us. It's good to have you with us.
Always fun.
Well, interesting times, I think, as that ancient parent curse goes. Let's talk, though, about how some will be out of a variety of different mortgage markets that we didn't necessarily first blush think. The rental mortgage market. How so?
Okay, so rental properties, refinances, long amortizations over 25 years, stuff like that can no longer be insured. So you have all these mortgage finance companies that rely on insurance in order to sell their mortgages to investors. Now they're looking for exits on these mortgages. So they got to go to people with a balance sheet, like a major bank, and say, "Hello, Mr. Banker, can you buy this mortgage from me?" Mm-hmm. And the banker's saying, "Wow, there's a lot of people that want me to buy their mortgages. So yeah, we can do that. It's going to cost you 15 basis points more on the rate."
Which, for those who are not familiar with the non-bank lending environment, because they don't have deposits, because they're not the big 5 types of banks, they take all these mortgages from their customers, bundle them all up, and then sell them off to get that cash coming in the door for themselves. You're saying that cash flow is going to dry up.
Yeah, well, they're going to have fewer products to sell at the most competitive possible rates.
So what does that mean to Joe Average, who may be a self-employed individual where one of the big 5 banks says, "Well, you're just a little bit too risky for our profile, go down the street." They go down the street, and what happens?
Yeah. Well, there's all kinds of repercussions. So there's the cost. The Department of Finance has tried to remove some risk from the market. And when doing that, they have raised the cost for consumers. So if you got a $300,000 mortgage, you got to pay another 15 basis points to refinance your mortgage, or you get a rental property mortgage at best rate. It's going to cost you a couple $1,000 over 5 years. So I would argue that, the guy with a $300,000 mortgage, most of those folks aren't living the high life. They're not going vacationing to Tahiti, sending their kids to private school, stuff like that. They're just getting by. $2,000 is a lot of money to them.
Well, then to that point, I wonder if we've just proved Ottawa's point, which is those who are getting those kinds of mortgages are the ones most likely to default if we have a black swan economic event, and therefore we need to remove some of that risk from the market.
Well, first of all, let me be clear. I think Ottawa had to do something. It's a question of what they did. So their theory is that, okay, we can't have the lowest possible cost for consumers and take the risks out of the market. It doesn't have to be an or situation. You can have both. You can have someone that is a hardworking Canadian that saves 5% of their income for retirement, has great credit, has never missed a payment, has a solid job. You can let that person refinance their high interest debt without risk. Okay, they're very, very low probability of defaulting. Okay? If you got someone that's putting down only 5%, that has a 42% total debt service ratio, which is high. Those kind of folks, you charge them more. Maybe you do, edge them out of the market. But what they've done is they've taken a sledgehammer and killed the fly with it. And they've done it without any consultation, by the way, which just stuns me.
So when we look a year down the road, what does the mortgage market look like to you?
Well, the rates are going to be higher for a number of products. The banks are in a great spot. My $1 million question is, are the banks going to have to qualify all of these mortgages of theirs, all of them, even the low ratio ones, the people with lots of equity, are they going to have to qualify those at the 5-year fixed posted rate? So prove that you can afford that higher payment.
Right.
That's the $1 million question. We don't know. OSFI's going to get back to us on that.
What's wrong with that, though? Sure, 250 basis point difference between today and that tested rate, but there will be a time over the course of the next 5 years where we talk about rates being normalized. The baby boomers are going, I was paying 18% in the 80s, so 4.6% is going to be nothing for these millennial punks.
Yeah, rates are going up eventually, no question about it. So it is good to stress test some people. Okay, but if you have, you're putting down more than 10%. When you're done your mortgage in 5 years, in today's regime, you can refinance. You can go up to a third-year amortization. You can get a lower payment than if, your interest rates were lower. You started with like a 2.5% mortgage, and rates go up to 4.5%. After that 5 years, as long as you have at least 10% down or more, you can refinance. If you get, if you can't handle that payment, you can refinance into a longer amortization and lower your payment.
So at the end of the day, you could still end up either lowering your payment, having the same amount. You're just not paying as much of the principal off.
That's right. And again, we're talking about, I don't want to call it tail event. I mean, the probability of rates going up 2% are probably higher than that. But the probability of that happening anytime soon is very questionable. When
do you see 4.6% as that normal rate versus the 2.2 we're at now?
Well, inflation is going to have to be higher than 3% in the Bank of Canada's upper end of its limit. So what's going to drive inflation, core inflation, up that high? Oh, geez. I mean, God only knows. I mean, do we have like an oil price spike? What's going to drive it?
So this is at least a 5-year conversation. So at the time at which we find ourselves with rates closer to that, it's about the same time the auto industry is telling us we're getting self-driving cars.
Yeah, hopefully ones that don't crash.
Good to have you with us.
All right, always a pleasure.
Rob McLister is the founder of RatesBuy.com.
Now to Dale Jackson, who has tax-saving tips to transfer cottage ownership.
Joining us now is your personal investor, Dale Jackson. He's going to look at a few tax-saving ways to transfer the family cottage. It could be a contentious discussion in some families.
It could. This is one of those things where this is not a business deal. This is a family matter, and it's very personal for that reason. And for that reason, too, it's very important that this is something that is discussed maybe when you're having that last bonfire down at the beach. And it's often not easy to get into, but there are a lot of things to think of, and there are a lot of things to talk about and find out what the family thinks about overall when it comes to transferring a cottage or a second property. Now, according to the CRA, the Canada Revenue Agency, from a tax perspective, it's considered a second property, not your principal residence. So when it is sold or transferred, you must pay a capital gains tax on the amount of money that it has gained in value, and that's 50% of the amount it has gained in value, and that's added to your regular tax rate. Here are BMO has a few suggestions in order to cushion the blow or to lower the taxes or possibly eliminate the taxes for some. The first thing is, of course, to pay the tax now, transfer the property to the next generation, and pay that capital gains tax.
And now means when the cottage is sold, at the point of sale.
When it is transferred. When it's transferred, so it stays in the family's possession. You could set aside the funds to pay the tax later. Either way, you would have to get the cottage appraised, find out what you feel the value is, and come in pretty close. You really don't know what it's going to be. One other suggestion from BMO is to use a life insurance policy that has a tax-free death benefits. The proceeds can be used to pay off the estimated capital gains when they come due. And you can avoid the capital gains tax altogether on the cottage by making the cottage your principal residence and avoiding that. Now, of course...
How long does it have to be your principal residence?
It depends. It depends on a lot of things, but it's something you should get on top of. Now, there's a lot of things to consider besides that, is that your principal residence then would become taxed. So you have to consider what is going to have the biggest capital gains to save you money. It doesn't always work that way. So you should talk to a professional and find out what your best course of action is. But the important thing is that you take that course of action now.
Thanks a lot, Dale Jackson, on a conversation that may take place in cottage country over the Thanksgiving Day weekend.
Stay with us, folks. After the news, we come back with John Petrides, Managing Director and Portfolio Manager with Point View Wealth Management. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
Let's find out about this mildly disappointing jobs report and what it says about the markets south of the border. We turn to Point View Wealth Management's John Petrides. He joins us from New York. Good to have you with us again.
Thanks for having me on, Michael.
Not the blowout jobs report that many had their fingers and toes crossed for.
Yeah, but not terrible either. Expectations were for 172,000 jobs. We got in around 156,000 jobs. Trying to pinpoint the number exactly is a very hard task to do. If you look at every jobs number, the prior 2 months are revised. In this case, the prior 2 months were revised up. So you need to look at, when analyzing the data, a longer stream of the data. And over the last 12 months, the U.S. has hovered around 200,000 jobs on average, which is very solid.
Okay, with having said that, it didn't look like it moved the needle on the Fed funds futures predictions for the overnight lending rate going up in December. It's still stuck at about 64%. You need to go all the way up to May of next year before you get a 3 out of 4 chance that's going to happen.
Yeah, I think for that, the Fed funds future market to rise higher, you needed a 250,000 or better job number and even a stronger wage rate growth. We saw 2.6%, which is still good. The Fed's not going to do anything prior to the election. And that is where we stand at this point in time. The Fed says the November meeting is live, but they're going to wait and see what happens with the outcome of the U.S. election. You still have 2 more jobs data ahead of you, and then we'll see what happens in December.
And at that point, it's been suggested to me that the Fed is so far behind the curve when it comes to where interest rates in the United States ought to be that they'll have no choice but to raise interest rates in December. What about as we move through 2017? At what point do we start talking about normalizing interest rates again?
Yeah, it's true. I think if the Fed had their choice, they would have raised rates further this year. But you had the Chinese devalue their currency in January. You had the Brexit vote in June. And now you have the presidential election here, which they don't want to interfere with. And I think they're waiting to see that if Donald Trump does become the next president of the United States, you could see a sell-off to the stock market akin to what we saw in the Brexit. And the Fed could be on hold because of what volatility may ensue. You just never know. That being said, though, if you do get maybe a Hillary Clinton election, 2 strong jobs numbers, it's not out of the question to think the Fed could be a coiled spring to raise rates in 2017. But again, trying to forecast what the Fed may do and trade off of that has been a very difficult job to do over the past 5 years.
You're predicting a Brexit-style sell-off if Trump wins. What does that mean for the Dow Jones Industrial Average? One market watcher told us 1,000 points.
Well, not predicting it, but that clearly is where investors in the market mindset is going towards with Donald Trump, because they just don't know what to make of him. They don't know what to make of his rhetoric and his policies, so and his actions of what he's saying. So it's hard for the market to really come to terms with that. So, you had a 2-day 5% sell-off in stocks following the Brexit vote, and maybe you get something similar to that. But who knows?
As far as the commodity reaction, we here in Canada are very focused on oil and gold, and it had been suggested to me we would see gold jump overnight by about $100 an ounce. John, what do you think of that idea? $100 additional per troy ounce?
Well, I have no idea where to try to figure out the day-to-day movement of where gold may go. I look at the bigger picture and see, with the exception of the Federal Reserve, global central banks are trashing their currency, and they're going to continue to stimulate their economies and continue to print more money until they get their economies in growth mode again, which means that gold should have a store of value. I mean, the only fly in the ointment there is when and how fast the Fed may raise rates. But I would take advantage of gold on this sell-off here.
Alcoa kicks off earnings season next week. It used to be a bellwether indicator of the health of the global economy. Are you looking at it from that perspective anymore?
Well, yes and no, in the sense that Alcoa has now split itself into 2 businesses, one that deals directly with making aluminum, and the other is for end products such as cans and aluminum body cars and for airplanes and things like that. They split themselves up to offer more transparency to investors. And I think you have to dissect the company that way. So you can look on the aluminum side and see what's happening with the global commodity market, particularly out of China. Maybe you can get some insight there. And on the other side, you can see what's the health and breadth of the manufacturing space and where are some trends such as aluminum-bodied cars. So I think it's helpful to read through each company's earnings and just hear the commentary to help put this picture of the global economy into perspective.
John, we appreciate your insight. Thank you very much for joining us from Point View Wealth Management.
We'll go to a break, and when we come back, David Prince of Harbinger Capital Markets Research, and then we'll conclude today's show with George Yarrow, who is Managing Director at RBC Wealth Management. Stay with us. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
So the British pound has headed into the weekend with the bounce off that flash crash that sent sterling to a fresh 31-year low. David Prince is taking a closer look at this and more. Back to our conversation earlier about algorithmic trading, program trading, fat fingers.
Well, and all those excuses have come out. What I would say to you, though, is what triggered it was probably the news from Mr. Hollande, who should look at his own backyard before he starts criticizing the Brits and coming down hard on that. As what the attitude was, well, we're going to come down hard on the exit. And that tipped the scales such that the markets really went into a tailspin. But it was Asian trading. And what annoys me so much about what's happening is you've got players in the game that are moving these markets around at ridiculous times in terms of the overall globe, and we're being forced to react to it. The reality is the British pound has declined measurably against the US dollar. It's moved downward against the euro. It's now made Britain much more competitive. So all of the doomsters that are going on about the negative impact of the pound, they should realize that this, in fact, is helping them.
I wonder, though, what that means then for Brexit negotiations.
Well, it actually puts the Brits in better shape than what a lot of people think, and that's the whole point that I would like to get across. It's clear that they want to start. They made the announcement they want to start them in March of 2017. When you look at what's happening in the other economies, and it's not just what's going on recently in Germany, we know we've got a referendum election coming up in December for Italy. Spain is being run by the socialists who won't give up even though they lost elections, so the conservatives can't take over. You've got a mess going on now in both Sweden and Norway. You add them all up, and suddenly you're starting to realize that perhaps Britain is going to be better off being outside of it for a while.
Okay, is that your actual assessment on that?
When I look at the numbers, you can actually make a case that the Brits will come out in front. Right. The big scare for the city, which is the London, is all the finance guys are going to go. Right. Well, given what we've just seen in the German banks, do you really want to move all the...
Right, they're not all going to end up in Frankfurt, is
correct.
What you're saying. Okay.
Nor are they going to end up in France.
So but back to the algorithmic trading, this is becoming increasingly an issue, and it's not going away anytime soon.
As I said, this has now hit the currency markets in a big way, and people are obviously going to be going back over this. The reality is that the market never did recover from where it was yesterday. The pound stayed below that all day. So that's kind of telling. So we're still making new lows, as you rightly point out. It's scary to think that a currency of that note would have that type of decline intraday.
Well, let's bring this into the Canadian dollar component, because we've seen crude oil climb to above $50 a barrel. Certainly didn't close there today or trade there electronically at this point. But we haven't seen the Canadian dollar move lockstep up with it. It's supposed to be the petrol currency.
Okay, and a couple of weeks ago, we were talking about how that was the week it was trading with the oil. We also said that one of the big things has always been the 2-year spread differential. And what you're seeing is that ours is way down below that of the U.S. And with the U.S. moving up, or potential moving up in rates, that's why you're getting the weakness, not only in the C dollar, but you got it in the Aussie dollar. So there is a definite belief in the currency markets that rates are coming in the States higher sooner, and the other countries will not be able to follow suit. I think I'm still going to be right that we're going to be in the low 70s by the time that we get this year, near the end of this year. But that said, when we look at what's happening in terms of our equity market, the bank stocks have held in really well relative to everybody else's bank stocks in the world. They still are a source of good income. It's just that what you'll see happening is more profit taking from foreigners as they look at what their exposure is on the C dollar.
I can imagine as well the foreigners are looking at the changes that are coming, mortgage rules in Canada, and wondering what that means for the big five, even though they wouldn't be anywhere near as impacted as you would see the non-bank lenders.
I don't think they really do. I think that most of it has to do with a lot of guys that just want exposure and they're deemed to be the best banks, etc. But yes, there will be an onus put back on the Canadian, or taken away from being on the backs of Canadians and being put back into the banks, meaning they'll have more capital requirements. So that's going to be more issuance. And they may do it in a preferred. That may be what they'll do, non-convertible preferred or something like that. So where I'm going with this is when they talk about the Canadian market, we are vulnerable if we get these resources coming down. And two that I wanted to go over this week were the oil and the golds. We had similar type of weird type of action in both those markets. I think it stems back from the Deutsche Bank issue of a week ago when we had a whole bunch of hedge funds that were forced into liquidating an awful lot of holdings. And I think part of it has drifted over into both the short position on the crude oil, which took it all the way to over $50 this week. And then I think in the case of the gold, it was a get-me-out trade. As soon as it broke 1,300, it accelerated. If you look at the gold chart, you're looking at something that will come down probably very soon to about the $1,200 level.
You know, is that tied to the idea that we'll see U.S. dollar strength on the prospect for an interest rate increase?
Yeah, exactly. So it is the other side of that. And when you see how quickly that accelerated to the downside, that wasn't just mom and pop that was selling that gold. Now we had a nice bounce today, but I don't think this decline is over. It's a short-term bounce. I think it'll move its way down as the dollar strengthens.
12.10 or so seems to be some
there's
support.
lots in that 12 to 12.10 area. On an overshoot basis, and who knows, when I'm on a deal with that type of commodity, lots of times things overshoot. So it could get down to 11.50. What I'm getting at, that's short term. And what you'll probably see is the typical seasonal uplift from here till the end of February.
Indian buying season.
The Indian buying season, and it still holds. I mean, last year you would have made a lot of money buying gold shares at the end of December or early part, the first week of January, and you would have sold them early March, and you've been up at least 25%.
At an Indian wedding over the weekend, boy, did I learn firsthand the value of gold.
I hope you brought gold with you.
Now to George Yarrow, who is Managing Director at RBC Wealth Management.
We're keeping our eyes on the price of gold. It's in and out of positive territory today. That's after falling close to 5% since Monday. For a closer look at where the metal is heading, joining us now from New York is George Yarrow. He's the Managing Director at RBC Wealth Management. George, nice to be with you today. Thank you for being with us.
Well, thank you for having me, saying hello to all my friends in Toronto.
Absolutely. Yes?
Absolutely. And yesterday, I happened to have been on the floor of the COMEX. We were having a meeting, and I did speak to a number of traders. As you know, I spent 35 years on the floors, and I think a little bit differently than a lot of people when I look at these things. And there are some things that we decided that shouldn't really ever be considered as prudent moves, is buying on an up spike on a Friday or selling on a sharp down move on a Friday. And then today we've had a big up move in the morning because of what we thought were friendly jobs numbers. And then thereafter we had two Fed speakers. And of course, every time we have Fed speakers, the price of gold sags. So we did sag during the day, and then we recovered a little bit near the close. So here we are, barely up on the day, but with the extreme volatility up and down on a Friday, normally that will signal a change in direction shortly. So I think next week we could have a different outlook as people start to realize that that low in the British pound due to the Brexit woes means a very low, weak currency all of a sudden. And anytime you have a weak currency, you want to be in something that's liquid, it's portable, and convertible into any other currency. And that, of course, gold fits that bill. So we may see some gold buyers come in because open interest also in the futures came off sharply from the end of last September. We had about 620,000 open interest in futures. As of this morning, we had 513,000. So we didn't really have a build-up in short position. But in the last option expiration, which was the 28th of the month in September, we saw thousands and thousands of options, put options, 1,300 down to 1,250, expire, abandoned, because on COMEX, options become futures contracts the next day if they're in the money. And this didn't happen. And so here, a week later, all these guys that had all these puts were out the money. Now,
yes?
I'm thinking that there's going to be a change. I think that with a low open interest, if we start to see a buildup in open interest volume and moving averages the next couple of weeks, the last quarter, which is now, will probably bring some asset allocators or fund managers into gold that actually fled gold like a month or two ago, because the first half of the year nobody needed gold because the stocks and bonds were performing so well.
So you obviously think then that the next trend or change in direction will be to the upside for the price of gold. But I'm wondering with respect to Brexit and the fall in the British pound and that flash crash we saw overnight, whether or not in the British pound, to be clear, that whether or not that really will cause investors to seek safety in gold.
I think some will. And then, of course, you have to look at the 90-day LIBOR. A year ago, it was like 0.30. And this, just the last time I looked this morning, it was like 0.87. So the 90-day LIBOR is really the basis for a lot of commercial activity, a lot of business. And as you can see, also our 10-year has crept up somewhat. So the market has done the Fed's work already. So even if we get the Grinch that stole Christmas hike in December, by the way, there'll be a big Fed meeting November 2nd, and then the Fed meeting that all our traders are looking at will be December 14th. Will be very interesting because it seems to be building up in the Fed funds rate the ability to show maybe 65% think that there will be a December rate hike. And that's what gold has been fearing, among other things, recently.
George, what's the price of gold a year out, do you think? Or are we going to be range bound?
Well, I think we may be closer to 1,400 than 1,200.
Okay. All right, George, we'll leave it there. Thanks so much for joining us. Appreciate it.
And thank you for having me.
Thank you.
I'm always happy to be here.
Great. Appreciate it. Have a great weekend as well.
Well, folks, that's it for Money Talk. Markets are volatile. We saw it in gold, fixed income investments, the stock market, and, of course, the currency markets. And it looks like it's here to stay through the American election, and with the help of our affiliate BNN and their excellent interviews and our producer Eric Green, we try to bring you up to date on the salient stories of the week. And I hope you are enjoying a good Thanksgiving weekend. And we have to count our blessings as Canadians. We'll be back on Sunday next week at 2 p.m. I wish you the very best and good fortune. And thank you for joining us on Money Talk. I'm John Budden, and you are listening to 580 CFRA.